Welcome to Lykken on Lending, the podcast that dives deep into the heart of the mortgage industry. Your host, David Lykken, bringing you the latest insights, trends, and updates from the world of mortgages. Whether you're a seasoned industry veteran or just getting started, this show is your go-to source for all things mortgage. Let's get started. This is Lykken on Lending. Now your host, David Lykken.
Folks, we're in for a real treat today. We have Laurie Goodman, who is a Institute Fellow at the Urban Institute. She founded Housing Finance Policy Center at the Urban in 2013. You're going to hear more about how her journey there. She was the co-director from 2013 to 2021. This center provides policymakers with data-driven analysis of housing finance policies issues that they can depend upon for relevance, accuracy, and independence. It's an important thing that they do, especially as we look at some of the policies that are being formed. Prior to joining the Urban Institute in 2013, Laurie spent 30 years in mortgage-backed securities as an analyst and research department manager at a number of Wall Street firms, including Amherst Securities Group, where she developed a reputation for her analysis of housing policy issues. And then again at UBS, where she was a top-ranked research analyst. She began her career as a senior economist at the Federal Reserve Bank of New York City. You could hear that when you listen to her talk in a few minutes. Laurie serves as a board of directors for the MFA Financial, as well as ARC Capital Group. She has published more than 250 articles in professional and academic journals and co-authored 5 books. She has a BA in mathematics from the University of Pennsylvania and an AM and PhD in economics from Stanford. Laurie, good to have you on the podcast. Listeners, we're in for a real treat today. We have a true housing expert who's well-known, speaks at many conferences, is well-published, and I'm talking about Laurie Goodman. It's so good to have you, Laurie, joining the podcast. Thank you so much.
Well, thanks so much for having me on.
Well, I always like starting out hearing people's stories. I mean, when we talk about how we got to where you're at, you're so well written and published and are so well known, but a lot of people like to know possibly how you got to where you're at. What's your journey to where you're at?
Well, I spent 30 years as a Wall Street mortgage-backed securities analyst trying to assess the implications of various actions on the valuation of mortgage-backed securities for the benefit of the investors. And it was a great job. And then sort of after the financial crisis, the government obviously put into place a lot of programs that had an impact on securities prices. So I started looking at public policy for the first time because it just was so influential in determining the valuation of these securities. And I just sort of fell in love with public policy issues. And then in 2013, when I sort of felt like, oh, I've been doing the same thing for 30 years and I'm a little bit bored, I have to find my next gig. I said, well, you know what? I really, really like working on public policy issues. This would be a great time to do the things I love, which include writing and analysis, and go to a think tank and start the Housing Finance Policy Center. You know, during the crisis, I got so many calls for, hey, can you explain this? What's the impact of this? What are the numbers here and there? And it became clear that so many decisions in Washington were made just on the basis of gut feelings because people didn't have data and they didn't have the analysis, and sort of being able to provide that would be a gift. It would also allow me to do something I love to do. So I started the Housing Finance Policy Center at Urban in 2013.
Yeah. And you have done a yeoman's work there since then. You can tell you love it. And I think one of the messages for anyone listening to this is find something you love to do. And you say, who in the world would like to look at data? Now, someone like Laurie does, and it is a passion of hers, and she makes so much sense of it. I can't wait to get into some of that we're going to be talking about as a result of your analysis. But tell us a little bit about the Urban Institute so people can become familiar with that. And we'll put a link to all of this, folks, in the website show notes.
Oh, well, thank you very much. The Urban Institute is a Washington, D.C. think tank, and I started and it spans a wide range of issues, everything from justice to health care to housing finance. And I started the Housing Finance Policy Center there in 2013, and now we're part of a broader Housing and Communities Policy Center.
The wealth of information that comes out of this institute is it's amazing, and anyone who's a serious professional needs to be aware of it. So we'll again put links to all of that. But let's get into some of the things that we're talking about. Laurie, one of the things you've been passionate about is loss mitigation. There's been an impact as a result of improvements to loss mitigation waterfall. I'd love to get your thoughts on that.
Sure. So loss mitigation is what happens when the borrower runs into trouble on the mortgage. So they're delinquent, and then the question is, what steps follow?
And
Sort of
the
prior,
waterfall concept, yes.
yes. And so prior to the financial crisis, there was no standardized loss mitigation waterfall whatsoever. The first standardization occurred in 2009 with the Home Affordable Modification Program, where there was a standardized process for getting a modification. Since then, there's been a streamlining in terms of the documentation. There's been a joining of the short-term and long-term waterfall. So prior to COVID, they'd say, "Oh, David, you're behind on your mortgage. Do you have a short-term problem or a long-term problem? If you have a short-term problem, we'll offer you forbearance where you don't make payments for a period of time, and then you catch up very quickly. If you have a long-term problem, we'll offer you a modification." And you say, "Well, gee, I don't know. I've just lost my job. I have no idea how long I'm going to be unemployed." And they'd pick one route or the other. In the aftermath of Hurricanes Harvey, Irma, and Maria in 2017 and 2018, the GSEs and FHA produced a sort of standardized waterfall where you automatically got forbearance for a period of time if you ran into trouble. That is, you didn't have to make your mortgage payments for a period of time. And then after that, they would evaluate whether you could resume your old payments, whether you could pay it back at once, whether you could resume your old payments, or whether you needed a modification. So when COVID happened in 2020, this was already on the shelf, although on a very small scale because it was the natural disaster waterfall. It became the COVID waterfall. And this was actually highly, highly effective. Out of 8.8 million forbearances, that is, people that didn't make their payment for a period of time, the number of home losses was extraordinarily low, on the order of around 2. So it was just extraordinarily effective. So then the GSEs and FHA said, "Oh, we should make this permanent." So in fact, they made this permanent. So now, rather than saying, "Do you have a short-term problem? Do you have a long-term problem?" you get a timeout for 12 months or so. Some lenders do it 3 months at a time. And then when you exit forbearance, you've got several options. You can pay back the forborne amount in a lump sum. You can increase your payments and repay over a year. You can keep the payments constant and defer the forborne amount until the end of the life of the mortgage. Or you can receive a modification where payments are reduced by on the order of 20%. If you still can't afford the mortgage, you will then move on to foreclosure. But this saves a lot of borrowers. So we did some work to figure out how many borrowers were actually saved by this. And we figured that it cuts the home loss. If you sort of think about home loss, there's sort of 3 stages. You go delinquent, and then you transition from serious delinquency to home loss, and then they liquidate your home, and there's a severity. So it cuts the middle piece, the serious delinquency to home loss rate, by 46%.
Wow.
So this is just extraordinarily powerful. It's powerful for borrowers because it means a lot more of them are able to figure out their difficulty and work through it. We figured out that during COVID, this feature alone probably saved more than 500,000 homes.
Wow. You think about the impact on families that has. I mean, that is significant. It's huge.
It's huge. And one of the really interesting things is if you push the analysis a little bit further, you say, well, listen, if your losses are going to be lower because you're cutting the serious delinquency to home loss rate so substantially, maybe you could afford to widen the credit box a little bit on the front end. Maybe you could afford maybe more marginal borrowers should be able to get homes. This is the part that I'm trying to sell now, and everyone is a little bit resistant. It's like, well, the COVID experience was the COVID experience. You don't know that it's going to be successful on a permanent basis. That was unusual. But even if the number isn't 46%, even if it's 25%, it's still huge, huge, huge.
A huge impact. Yeah,
Yes,
positive.
it has a huge impact on borrowers, and it should make you more confident in making mortgages that are just at the border of being acceptable.
Yeah, I think it's a lack of understanding that causes people to not be open to that idea. But, how far is far enough and all of those things. Another topic we need to touch on is renovation financing. Laurie, you and I were talking about how serious of a problem this is across America. Even certainly in our older communities, there is such a need for improving renovation financing. What is the Urban Institute saying about that, and what's your position?
Yeah, so renovation financing is a huge issue. I mean, we have a very aging housing stock. The average home in this country was built in 1980. It turns 46 this year. Happy birthday. The housing stock has aged, it's basically it's aging very, very quickly because we're not building as many new homes, and people are always trying to do renovations on their existing homes, and financing those renovations is just extraordinarily high. The denial rate is very high. It's on the order of 40%. So, you buy home and you want to renovate it, or you want to renovate an existing home, the denial rate is extraordinarily high. And, and there are things that can be done within existing programs, and we also have to think about new ways to do things. So when you think about so FHA has a renovation program called the 203K program, and
Around for all.
undoubtedly you have underwritten mortgages on that program for years, but it's not very well used. And
No,
they've improved it significantly in 2024.
I remember that.
But
But it's still
even
not
and
being used. It's still not being used to the levels that it should be, in my
it's still
opinion. I
not
mean,
being used, and part of it is, they increased. If you're over a certain threshold, you need a HUD consultant to help. That threshold was increased from 35,000 to 75,000. Even so, you're not really getting the traction. A lot of lenders feel that it's very cumbersome, and there still aren't enough HUD consultants for the larger renovations. On the GSE side, on Fannie and Freddie side, the bank has to, or the financial institution who is underwriting the mortgage takes the risk until the renovation is complete. That is, Fannie and Freddie have recourse back to the lender. And that turns out to, a lender looks at me and says, well, Laurie, how do I know you're going to do a good job on your kitchen renovation? You've never done a lot of kitchen renovations. How do I know your contractor isn't upselling you like crazy? And the answer is they probably are. So I think, one way to rethink this would be to shift renovation risk to the parties that are best able to manage it, which is the contractors. So, and this would be a very, very major shift, but you say,
yeah.
I'm just going to use Home Depot as an example because they do renovations and they have a lot of subcontractors where you say, Home Depot, you are one of three renovators you're one of three Fannie Mae approved renovators in Atlanta. In exchange for being one of our preferred vendors, you will do renovations at a fixed cost. You quote the price. If you have an overrun, it's your problem. The renovation will be performed satisfactorily. You will essentially guarantee that renovation. There'll be an inspection at the end. And that sort of de-risks the lender, who is in no position to, usually not in a great position to oversee the renovation. It transfers the risk where it belongs, but it would be a very major shift and would require a preferred vendor approach because you've got to qualify the vendor, and the vendor has to be willing to do the renovation at a fixed price. But that's sort of the alternative model that I think we have to go to get a lot more. And the renovator has to also assure that the home will appraise out. That is, the renovations will be reflected in the cost of the home. And I think that, or at least if it isn't, won't go over the LTV threshold. So, it's a very different approach, but I think one that would be good for everyone and
Yeah.
transfer the risk where it belongs.
Yeah, it's exactly, it transfers the risk where it appropriately belongs. What is the headwinds to having adoption of some of these kind of recommendations you're coming up with?
I mean, I think this would be a great recommendation, but it would require a preferred vendor approach because you wouldn't be willing to have, you, you wouldn't be, if I would decide to set up shop as a vendor, Fannie Mae would not be convinced that I would complete the job on time and on budget, and therefore they would have the risk. So you have to have a limited number of preferred vendors who are willing to do this at a fixed price and guarantee it that you have confidence in that you qualify.
Well, it's an opportunity out there, and I want to cover a lot of topics with you today. So if people are hearing this, and I think most everyone recognizes the need for renovation, financing, and create new creativity. Do you advise on those, helping institutions do that? Is that part of the Urban Institute's role?
No, that's not part of our role.
Okay, so you identify the issue, write about it, and then encourage people to move towards it.
Right, and try to think about solutions that are maybe a little bit out of the box. Even within the box, there are things you can do to improve the process, maybe lower the denial rate a little bit. Things like, making sure the 203K program has enough HUD consultants, for instance. Fannie and Freddie might want to consider a standalone second lien renovation funding program for those that have like low rate mortgages. At one point, they were thinking about a cash out refi program. Doing cash out refi specifically for renovation financing is another option that might make sense. So we tend to think about options that would make sense that could be implemented.
Right. And then that's good. If someone wants to look at the options you've created, what's the best way for them to do so? This is one that's near and dear to my heart because I drive through cities and towns and I'm going, what a need for renovation.
Yeah, I know. It's like
just heartbreaking to see such beautiful homes continuing to go into disrepair, further and further into disrepair, to the point some of them the only solution is to bulldoze them down and start over again.
Yeah, there's such a huge need. And I mean, the fact that your average home was built in 1980 is just such a shock. 1980 is just such a shocking number. 50% were built before, 50% built after, and we're in 2026.
That's a staggering. Well, I hope you continue spending time focusing in on that, Laurie, because that is one that you and I share a passion for. Let's move over to improving and standardizing mortgage refinancing. Everyone's thinking we're going to have this big refinance wave. It appears that rates may have stabilized. In fact, we may have found that we're now at the bottom of this rate cycle and we could be going up, but refinancing continues to be something that people need to do. Talk about what this institute is doing when it comes to standardizing mortgage refinancing.
I mean, so basically, rates are something that we don't control. What you really want is that if rates go down, people have the opportunity to refinance when it is advantageous for them to do so. What you don't want is for people to refinance when it is not financially advantageous for them to do so. That is, if rates are unchanged, they shouldn't be refinancing in order to generate an additional loan application for their lender. And so what we have found is that people oftentimes don't refinance when they should. People oftentimes refinance when it is extremely marginal for them to do so. And that is particularly true in the VA world, in the VA loans, where there's a lot of churning. FHA and VA both have streamlined refinancing programs, which makes it very, very easy to do the refinancing. The GSEs do not have a streamlined refinance program because of the CFPB's ability to repay rule. That is, you have to, every time you do a new loan, you have to make sure the borrower qualifies. Well, if you're Fannie Mae and you already have my loan, it doesn't make sense to requalify me to make a lower payment because my probability of default has gone down. So therefore, you as Fannie Mae are in a better position. You should be eager to have me refinance that loan. So there are things that the CFPB could put in an exemption into the ability to repay rule for rate term refinances where you're not increasing the loan amount and the lender already has the risk on that loan. That would make total sense. It would also make sense to think about redoing both. FHA and VA have various benefit tests to make sure it's in the interest of the borrower to refinance, but these tests are really, really easy to game. So you end up with borrowers doing, as I mentioned earlier, very marginal refinancings. If you did not allow borrowers to roll costs and mortgage insurance premiums into the loan amount and instead required them to roll it into the rate, you would allow borrowers to do a much more apples to apples comparison.
Good point. Really good
And
point.
so that's, so we've been trying to push that point, is that you have to rethink the refinancing process. Yes, make it easier so borrowers who can refinance when they should, but but discourage them from refinancing when they shouldn't.
Yes, it makes total sense. And we've seen a lot of refinancing abuses. In many ways, that's why Dodd-Frank came about, because of the abuses that were there. And it's good to see that you guys are studying that and looking at that. We are overestimating the home ownership rate for young adults. We talked about this. I am so excited for you to share some statistics because it's quite different than what's being published out there. Explain what we were talking about.
Yeah, so the homeownership rate for young adults looks like it's fallen somewhat, but it's actually fallen more than it looks like, because we define homeownership rate as homeowners divided by homeowners plus renters. So if you're living in your parents' basement, you're neither a homeowner nor a renter. You're simply not counted in the numbers at all. And so when you look at what's happened to young adults, and I'm going to define a young adult as the 25 to 34-year-old age
Yep.
group.
Which is the standard which has been traditionally the age group which is buying their first home.
Yes. So you look at the percentage of 25 to 34-year-olds living with their parents. That number in 2005 was around 12%. In 2024, it was 20%. The number of young adults living with others was 18%. It was 14%. It's now 18%. So if you add those two numbers together, in 2025, about 26% of 25 to 34-year-olds were not independent households. Now that number is 38%.
Well, in the wrong direction.
It's going the wrong direction, and we're not counting these people as either homeowners or renters. So when you look at the home ownership rate, it's actually a lot lower because these people aren't in the equation at all.
How do we start collecting that data? How is it a Census Bureau?
That's census data. This is just American Community Survey data.
Yeah. And
there's no trick to the data. American Community Survey does a marvelously good job of collecting the data. It's all available. We're just not using it properly.
Interesting. So fascinating. That is a statistic when we were talking that kind of blew me away when you look at it. The biggest hurdle, I'm assuming, is the cost or affordability of housing.
Affordability
today.
is a very major problem.
Yeah. Any other things that are there that we should be aware of that we're not thinking about, Laurie?
Obviously things like, a lot of times people get out of their parents' basement when they get married, but certainly, in less constrained areas, people get out of their parents' basement the minute they can afford to do so. So yes, affordability is the number one issue. Certain milestones are happening later in people's life, so the push to get out isn't quite as powerful. But affordability is, again, the single largest issue.
Yeah, it's amazing. Let's talk about the evolution of the institutional single-family rental market. That's another area I know the Urban Institute spends a lot of time looking at. Talk about that one.
Yeah, so if you the institutional single-family rental market is very interesting because it didn't really start until 2011 when Invitation Homes basically said, listen, homes are just so cheap. There's room for us to come in, improve them, and rent them out. So that was the birth of the market. And, it's still a very small market. Institutional investors are something like 4% of total single family homes. It's obviously
Yeah, it
concentrated
sounds
in
like it's
certain
bigger
areas.
than that. When you talk to some people, it seems like it's a bigger number, but it I found institutional ownership of homes, single family, it wasn't as much, it wasn't as large as.
It's it's tiny, and this is against a background where 85% of single family homes are owner occupied. So we're talking about 4% to 15%.
Wow.
So
Yeah.
it's a fairly tiny number. The reason it gets all this attention is it is probably the single issue that polls well on both sides. Everyone dislikes institutional single family investors. Something like 75% of everyone thinks, dislikes this category. So it tends to get outsized importance, tends to get outsized focus relative to its impact. But again, it's relatively small. And when you look over time, there's been a real evolution. So initially, these single family operators were buying foreclosed homes and had actually put a floor in terms of how much home prices fell in the aftermath of the great financial crisis. They then moved to the multiple listing service around 2015, 2016, and then sort of around 2021, 2022 started focusing more heavily on build to rent because there wasn't a lot on the multiple listing service. And the important thing to realize is on homes that institutional family operators buy, these homes are disproportionately homes that need repair. Why? We just talked about the difficulties in getting renovation financing.
So true.
And so if I walk into a home where I can imagine my curtains on the seller's window, that home is going to go to me as an owner occupant, is not going to go to an institutional investor.
Yes, that's
But if a
great.
home that needs repair, I as an individual investor, I as a owner occupant are going to have trouble financing that home. And an institutional investor is going to be able to finance the home more easily. They also will be able to do so much, much more economically than
So
I can. That is, they know exactly what repairs have to be done, what repairs should not be done. They won't be upsold because they've done this a lot of times, and they've got this paint, this carpeting, these HVAC systems, and they buy it all in bulk. So they'll be able to do those repairs much, much cheaper than I can, and they can finance those repairs.
yeah, it it's a way to solve some of the problems of whether people stay in a home or not and what they do. So I look at a lot of what you guys are studying. Do you guys look at the macro view of the housing market just generally? What is going on? Are we seeing an expansion? What is the future of housing, the American dream in America, Laurie, based on what the Urban Institute's saying?
I mean, it's sort of hard to paint a really long-term picture. Sort of short-term, we think rates are going to remain elevated. As you point out, we're sort of there's not a lot of scope for rates to go down a lot. Meanwhile, home prices are very high relative to affordable levels. I do not think they're going to come down appreciably. What you're going to see is that they go up very slowly or not at all for a number of years while wages continue to increase and affordability gets restored in that manner. Household growth is definitely slowing, which sort of feeds. So over time, we're going to partially work off our supply shortage, not entirely because that supply shortage reflects both the homes that aren't there, but also people living in their parents' basement that would love to get out the minute they could afford to do so. But I sort of see home prices going up very, very slowly over the next couple of years, taken as a whole, and affordability being restored, sort of more coming close, and homes coming closer to affordable prices over the next few years.
Laurie, it's so good to have you be on the podcast. I'm so grateful for your time. A lot of good information here. How can people get a hold of you to ask you to speak at the conferences and learn more about the Institute?
So, the the Urban Institute has a website, www.urban.org. That's the single best way to follow our research. You go down, look at housing and communities, and then Housing Finance Policy Center from there, or just, drop my name in the Dropbox and what I've written will come up. But it's a very, very good website that has all of our work, not just it has all of Urban's work, not just mine. And a lot of people find a lot of other things they think are interesting on that. And my email address is first initial last name @urban.org. People can find me there.
I encourage people to reach out to you. Laurie, again, thank you so much for being here. It's so good to hear what you have to say, but more importantly, that there are people like yourself that find great joy in diving into that data, and you do it exceptionally well. When you hear you speak, it's just, I've never seen anyone talk about data with the passion that you do. Thank you.
Well, thank you very much for having me. It's been a pleasure. Thanks very much.
Yeah, I appreciate it. Thank you. Folks, I hope you enjoyed this podcast. We want to thank our sponsors for making it possible. First Close, Title Eased, Byte Software, Angel AI, True, Candid, the Mortgage Bankers Association of America, Lenders One, Modex, Redder, Mortgage Advisory Tools, and Fuel.io. Check these all out. And by the way, the website is myfuel.io. I appreciate you all. Thank you so much for being here, and share this podcast with others. See you back here for our next podcast.
You've been listening to Lykken on Lending. Our passion is to bring you the latest insights, trends, and updates from the world of mortgages. So on this show, if you're a seasoned industry veteran or just getting started, it's your go-to source for all things mortgage. We hope you've enjoyed the show. We'll be back soon. Take care, and we'll see you next time on Lykken on Lending.